Okay, I think we're a few minutes past the official start time, and it looks like we have a good amount of people who've joined up so far, so we'll go ahead and get things started. Good evening, my name is Colin Plackey, and on behalf of the Rigs to Real Estate community, I'd really like to welcome you out to this webinar tonight. Now, I'll speak about my background and my experience here in a few minutes, but first I want to make a few statements right off the bat. Now, most of you are probably thinking that you're here to learn about how to get started investing in real estate. But that's not entirely true. I mean, sure, the next 45 minutes will be focused on real estate investing, but that's not why I'm here, and that's not why you're here. You and I are here because we have the same problem, a nasty, persistent problem that rears its head unexpectedly a few times each and every decade. As oil and gas professionals, we're conditioned to roll with the punches and deal with the volatility of our commodity price-driven industry. When times are good, they're great. When times are bad, it seems like the world is ending and there's no hope for recovery. You've probably heard the oil man's prayer, Lord, grant me one more oil boom and I promise not to screw this one up. Pretty fitting quote for the situation we find ourselves in today, isn't it? The only problem is, that's not a new quote. It wasn't coined in 2020. It wasn't created in 2015, and it's not from the crash in '08. It's actually from a bumper sticker in the 1980s, which means the phrase itself was probably popularized long before that. Guys, that means this phrase is 40 to 50 years old at least. That's 5 decades, 2 entire generations of oilfield personnel. You think by now we would have learned our lesson? Unfortunately, for the majority of oil and gas professionals, that lesson will always be learned the hard way. But not for us. I don't want anyone listening to this webinar, whether you're here live right now or listening to a recorded version of it later, to ever learn that lesson the hard way again. We're here to combat the frustration and vulnerability each of us feels each and every time we look at the oil price charts, when we hear there's layoffs coming, or every time we see the rig count drop. We're here to find stability and a way to smooth out the ups and downs of the oil and gas industry. Now, I truly believe that real estate is the safest, most obtainable, and proven way to smooth out the ups and downs of this industry, and myself and many other successful investors in the rigs to real estate community are living proof of this. Real estate is well suited for oil and gas professionals. It offers stable, predictable income that can be used to smooth out the ups and downs of our industry. It has incredible tax benefits, which means you get to keep more of your profits. It has historically outperformed the stock market, and if done correctly, it can be completely passive. So you don't have to worry about being distracted from your job or having to give up spending time with your family. Now, I don't want to make it sound like it's the only way or it's a sure thing. You may make it through this webinar and come to the conclusion that real estate isn't the right path for you, and that's perfectly fine. I'm not naive enough to think that just because it has been a blessing and a safety blanket for myself and others, that it's the only solution for everyone. Here's the bottom line. None of us should have to feel that frustration, fear, and vulnerability we feel when our livelihood can be ripped out from under us because of a demand problem or a supply glut, or OPEC manipulating markets to bankrupt American oil and gas companies. We need to make a stand and decide once and for all that we will no longer live from boom to bust. In order to do this, we must take matters into our own hands and work to build wealth that is not based on commodity prices or the stock market. Tangible wealth, wealth that can be handed down and last for generations. And I'm here to tell you this is all possible through real estate. Okay, probably by now you're thinking, good Lord, what awful things happened to Colin in the past to get him so fired up and going off on rants talking about taking a stand and deciding this once and for all, blah, blah, blah. Well, it all started when I received an invitation to my own wedding, inside of which was a note from my fiance that read, "Hope you can make it." Yes, you heard that right. An invite to my own wedding from my fiance, "Hope you can make it." It's a true story, it's my story, and we'll get to that in a minute, but first, I want to quickly introduce myself and my background. I grew up in Plano, Texas, and graduated from Texas A&M University in 2010 with a degree in petroleum engineering and a minor in geology and geophysics. I have roughly 10 years of oil and gas industry experience in various operational and financial roles in several basins across the Rockies as well as the Permian Basin. I started investing in real estate a few years ago, and since then I've built a portfolio of large apartment complexes in Tennessee, Alabama, and Texas, adding up to about 1,000 units total. These investments spit out enough income in the form of cash flow each month to more than cover my living expenses, and I spend very little time or effort managing them. I'm going to explain how this was all possible in this webinar. But the thing is, it wasn't enough to just free myself from the burden of the financial stress and worry our industry puts us through. I made it my mission to educate other oil and gas professionals how they too can create passive income each month from professionally managed real estate investments. That way they can help themselves counteract the volatility we experience in this industry. You've probably seen some of the educational articles I've written on LinkedIn, Forbes, or the Denver Business Journal. However, I'm not here to persuade anyone to buy into a particular investment, and I'm definitely not here to hold your hand the entire way. Ultimately, you have to decide if real estate is the right path for yourself and your situation. I like to think of it this way. If you're Clark Kent and real estate can make you Superman or Superwoman, then myself and the Rigs to Real Estate community is simply your phone booth. Now, my wife told me that this was a dorky analogy, but it's the best way I can describe it because in reality, you have to be the hero in this story. No one else is going to rush in to save the day for you. I'll provide you with the knowledge and tools to get you started and help you avoid the common pitfalls and expensive mistakes people make early on. But ultimately, you have to decide what is right for you and take action. I'm just here to give back to the oil and gas community and help other oil and gas professionals create that same safety net of passive income from real estate that has helped me along the way. There was a time that I didn't have a safety net, so I know what it's like to have my back against the wall with seemingly nowhere to turn. I wish there would have been a community like Rigs to Real Estate for me back then because it would have saved me a world of hurt. It all started in late 2015 when my boss and an HR rep stepped into my office one morning and asked to close the door. I knew my time had come. Prior to this, my degree in petroleum engineering had provided a comfortable living. However, it all began to unravel in September of 2014 when OPEC made a landmark decision which sent the U.S. oil and gas industry into a catastrophic tailspin. By February 2016, the industry was in the depths of one of the worst downturns in oil and gas history. I had been out of work for 3 months and I was watching my savings and investment accounts dwindle towards zero. Then I got the call. The person on the other end of the line said they had a job for me, but it was in Midland, Texas, and they would provide no relocation assistance. It was Thursday. I replied, "I'll be there Monday." My fiance had a good job in Denver, so we decided it would be best if I moved to West Texas alone, and we would decide later if she would move down. 5 months went by with us living 800 miles apart, and our wedding date was fast approaching. In her dark but hilarious sense of humor, my wife mailed me an invitation to my own wedding to my one-bedroom apartment in Midland. "Hope you can make it," the invite read. I thought it was hilarious at first, and then a paralyzing thought struck me. I realized no matter how much money I put away in retirement accounts or the stock market, I was still at the mercy of my volatile job and industry. I literally moved halfway across the country on 3 days' notice, leaving my life and my fiance behind because I was so dependent on oil and gas income. I also realized that my savings in the stock market were essentially useless when my income dried up. I mean, sure, the investments had gained value over the years, but they provided no income to support myself or my soon-to-be family. I ended up having to sell them to pay bills, and when I sold them, I was hit with outrageous capital gains taxes. Now, as it turned out, accepting that job on a Thursday and moving to West Texas on a Monday was the right decision to make. After spending a year in Midland, I was eventually given the opportunity to transfer back to Denver. I worked with some incredible people along the way, and I've made a few lifelong friends, and I'm still working at this company today. However, the lesson stuck with me. I had to be prepared for the next downturn. I knew stock investments with no income were useless when jobs dried up. I needed something different, something better, something besides the tired old strategy of blindly feeding money into the stock market and hoping it would gain value. Throughout my oil and gas career, I lived by the mantra, hope is not a strategy. Yet with my own personal investments, I was clearly ignoring my advice. After moving back to the Denver office, I got busy at work and home and started to lose sight of my goal to find a better investment. And I probably would have been lulled back into the same routine and flawed investment strategy that failed me in 2015 had it not been for another slap to the face wake-up call. This wake-up call started with one of those Powerball or Mega Millions jackpots that was approaching $2 billion. A group of friends and I were sitting around discussing what we would do with such a ridiculous amount of money, envisioning how we would spend it, the cars we would drive, the traveling we would do. Everyone in the group was caught up talking about the outlandish things we'd do with the lump sum if we won. Well, almost all of us. My buddy Brian Elwood sat quietly to the side, deep in thought, crunching numbers on his phone's calculator. Finally, he spoke up, and what he said would change the way I viewed investing forever. He said, with that $1 billion lump sum, I could buy 20,000 apartment units, which would give me a monthly income of around $7.5 million after expenses. We all stared at him blankly. The comment was so far removed from the conversations about which different Ferrari or Lambo we would drive on which day of the week. His simple calculation hit me like a ton of bricks. Now, I knew a little bit about Brian's story prior to this. I knew a few years out of college he lost interest in his unfulfilling corporate job and began accumulating cash flowing rental houses in Tennessee. I knew those rental houses generated enough income for him to maintain a comfortable lifestyle in an expensive part of Denver. I also knew that he only spent a few hours per month managing his rentals, and he essentially paid zero taxes on his income. On top of all that, Brian and his wife literally used an Excel spreadsheet to decide which city in the US they wanted to live because his real estate investments provided them with the flexibility and freedom to live wherever they wanted. They faced a really tough decision deciding between destination cities like San Diego, Portland, and Denver. Meanwhile, I had to leave my fiance and my life in Denver behind to move 800 miles away on 3 days' notice because I was so dependent on my oil and gas income. He had figured out the key to building wealth, and even $1 billion hitting his bank account wouldn't change the way he invested. I want you to really think about what I'm saying. Can you imagine an investment you were so passionate about and believed in so heavily that even $1 billion windfall wouldn't change the way you invested? This was it. Finally, my aha moment. Cash flowing real estate was my solution. It checked all the boxes I was looking for. It provided stable income via cash flow to cover bills when times got tough in the industry. It consistently outperformed the stock market and was especially resistant during recessions. It appreciated over time so I could generate wealth and leave a lasting legacy for my family. And it could be passive in nature so I could have more time to spend with my family. And best of all, it had generous tax benefits to help ease my frustration from paying high taxes my entire career. I have to confess, sometimes I can be a ready, fire, aim type of person. So as soon as I made this discovery, I was ready to jump headfirst into real estate investing. That's when I hit my first roadblock. I had no idea how or where to get started. And now a lot of you sitting here in this webinar may be in the same spot I was. Look, coming to the conclusion that real estate investing is the best way to generate wealth is the easy part. There's ample evidence that supports this conclusion, and it's certainly no secret that America's wealthiest families have utilized this asset class for generations to protect and grow their fortunes. The problem isn't discovering real estate investing is the answer. The problem is discovering where to start and how to take action. If you're like I was, you probably read numerous books and consumed hours of podcasts and YouTube videos about real estate investing, but they left you feeling more confused than when you started. There were so many routes to get into real estate investing, I was overwhelmed trying to decide which route was best for myself and my goals. I was stuck, paralysis by analysis. This is actually a common stopping point for many people. We feel so overwhelmed by the choices, we end up not taking any action and reverting back to our old routine of blindly feeding money into the stock market, only to get burned again. Let's take a moment to clear the air on this issue right now. Yes, there are many ways to make money from real estate investing, and each one has its pros and cons. Let's talk about how I overcame this obstacle so that if you're stuck on the fence at this same point, you can hopefully learn from my experience and have more clarity on which route you want to take with your investments. We'll start by breaking down real estate investing into two major categories. The first category is transactional-based real estate. The most common route in this category is flipping houses. Now, I'm not going to spend a ton of time on this method because you've probably seen all the HGTV or TLC shows depicting various people buying cheap houses, fixing them up, and selling them for a quick and easy profit. Now, as appealing as the TV shows can make this route look, I knew it couldn't solve my problems, and here's why. First, transactional-based real estate is just that. It's based on your ability to make transaction after transaction after transaction. You're essentially creating another job for yourself. Another job where you only make money if you continue making transactions. If you can't work or the market turns sour on you and you can't unload your flips, you'll be back to having no income to come in and smooth out the ups and downs of the oil and gas industry. The other problem with house flipping is the profits are considered ordinary income in the eyes of the IRS and subject to heavy taxes. I wasn't looking for a second job, and I certainly wasn't looking to increase my tax bill each year. I was looking to build something that would continue generating wealth while taking advantage of lucrative tax benefits, whether I was actively participating or not. If that sounds more like something that you're looking for, then it's time we talk about the second major category of real estate investing, equity-based investments. This category involves long-term ownership of single-family or multifamily rental properties and is really the only category that oil and gas professionals looking to build stable and predictable income to balance out the volatility of our industry should focus on. Like most people at this stage, I chose to get started by investing in single-family homes for several reasons. First of all, the vast majority of educational content available revolves around single-family investing, so I felt like I knew more about it than multifamily. Second, I had a certain comfort level with starting with one house at a time. In hindsight, this should have been my first red flag because I've since learned that just because you're comfortable with something doesn't mean it's the right choice. In fact, I'd argue most growth, both personally and financially, doesn't begin until you leave your comfort zone. But let's get back on track. Anyways, like I said, I started with single-family investing. More specifically, I started with the single-family BRRRR method, which stands for buy, rehab, refinance, rent, and repeat, which is a crafty way of saying I would pay cash for a run-down, haunted house in a decent neighborhood and fix it up to where I could refinance it with a traditional loan from a bank, place a tenant in it, and then sit back and collect monthly cash flow. Ladies and gentlemen, this method works. I'm not here to say that it doesn't. I bought my first investment property for $90,000 and I was all in for $128,000 after a $38,000 rehab. After the renovation, the house appraised for $170,000 and I was able to put a 75% loan-to-value mortgage on the house, which put about $127,000 of cash back into my bank account. The monthly rent is just under $1,400 per month, which means I keep roughly $250 cash flow per month after paying the mortgage, taxes, insurance, property management, and setting some funds aside for maintenance. After closing costs and everything was all said and done, I had roughly $5,000 invested in the house, $40,000 in equity on paper, and cash flow of about $3,000 per year. $3,000 per year on a $5,000 investment is a 60% cash-on-cash return, which would make any investor's mouth water, right? Like I said, this method works, but there are a few reasons why it wouldn't work for me long term, and why it probably won't work for those of you listening to this webinar either. First of all, it was a pretty hefty distraction from my full-time job as a petroleum engineer. I was fielding all these calls in the morning, during lunch, after hours, from contractors during the rehab, mortgage brokers during the refinance, title companies, property managers, and 100 other people who needed something from me for the entire 2.5-month timeline the project took. The second and most alarming thing I realized was that I would have to do this process 60 times in order to replace my oil and gas income. So the question became, could I repeat this process 59 more times before getting fired from my job? Now, I love what I do, and I love our industry, so I wasn't about to jeopardize the position I had for real estate. You have to admit, it would be kind of ironic if I lost my oil and gas income because I was too distracted by real estate, when the sole purpose of starting down this path was simply to smooth out the ups and downs of our industry. I had hit another wall, stuck again. I had proven to myself that I was capable of making great returns in real estate, and I was truly enjoying the ride. But how could I possibly achieve my investing goals without putting my job and career at risk? Well, I had heard that when it really came down to it, 5 to 8 unit multifamily properties took about as much time and effort to acquire as one single family house. Perfect solution. I could do 5 to 8 units at a time and reach my goal quicker. Maybe I could reach 60 units before getting fired after all. Now, one thing I learned early in my oil and gas career was the importance of never being too proud to ask for help from more experienced hands who had been there and done that. So that's exactly what I did here. I started networking and having conversations with more experienced and successful real estate investors that were taking down 5 to 8 unit properties to see how it was all done. To my excitement, they all confirmed that closing a 5 to 8 unit property was not much more work than a single family home. However, I noticed a pattern begin to emerge. The 5 to 8 unit guys and gals all said, yeah, 5 to 8 units is great. I'd never do a single family home again, but I can't wait to sell all these and get a 20 to 40 unit building because the expenses are lower. So I thought to myself, okay, if they went from single family to 5 to 8 units, but now can't wait to get to 20 to 40 units, maybe I should just skip this step and go straight to 20 to 40 units. So I started conversing with investors having success in the 20 to 40 unit range, and again, after several conversations, the same pattern emerged. Yeah, I love 20 to 40 unit buildings, and I'd never do another 5 to 10 unit deal, but I can't wait to sell these things and get 85 units and above because they run more efficiently. Clearly, this was starting to sound way out of my league, but I continued on the path and started talking to successful investors in the 85 unit plus space, and it turns out everything the 5 to 8 and 20 to 40 unit investors were telling me was 100% true. It's a proven fact that bigger buildings have lower expenses and run more efficiently. Now, the best way this was explained to me was by a highly successful investor and thought leader in the multifamily realm, a guy by the name of Rod Khleif. In 2006, Rod had amassed a portfolio of 500 single-family homes. In 2007, his net worth went up by $16 million while he slept. In 2008, he lost it all. A $50 million portfolio gone seemingly overnight. He explained that when the market turned, expenses on single-family homes started to add up and destroy his cash flow. Even if something as simple as a faucet broke, he had to send a repairman to the house, see what kind of faucet it was, the guy that would run to Home Depot, get a replacement, go back to the house, oh crap, wrong part, back to Home Depot, back to the property, then he was finally able to fix the sink. All-day labor plus parts to replace a sink. Now, during this same time, he owned a 100-unit apartment complex that weathered the housing crisis of 2008 as if nothing had happened. What was the difference? Well, if a faucet broke at his apartment complex, it was no big deal because every sink in the complex was identical. So they had 5 spare faucets in a storage closet, plus a full-time maintenance man on location. At his apartment complex, it was a simple 30-minute fix versus the all-day affair of a single-family home. That is the power of 85 unit plus buildings. They have multiple redundancies when it comes to items typically needing repair, plus full-time maintenance and a leasing office on premise. So at this point I'm thinking, great, 85 units plus is the way to go. How about I just hop on over to Zillow and start making offers on $10 million apartment complexes, and I'd be well on my way to retirement, right? Now, obviously, I didn't have the experience or the funds to even consider taking on a project of that magnitude, but it turns out I didn't have to. After talking with successful investors in the large multifamily space, it turned out that when you enter the realm of 85 unit or larger apartment complexes, it's no longer a one-man show. It's very much a team sport. Also, at this level, it's rare that all the money required to take down a property comes directly from the team in charge. Most of the time, the funds are raised privately by partnering with private equity funds, family offices, or individual investors who bring the majority of funds needed to close the deal in exchange for an equity position and a return on their investment. Light bulb. If professional investors like private equity funds and billionaire family offices chose this route as their preferred method of passively generating wealth through real estate, it had to be good enough for me, right? This was the answer I was looking for. I could invest passively alongside other individual private investors in institutional quality real estate managed by experienced professional real estate investors. Not only was it the answer for me, but I truly believe passive investing has the lowest risk and offers the highest return for any busy professional looking to add real estate investments into their portfolio. Why? Well, first of all, you're investing in multifamily real estate, which offers better returns than the stock market while also experiencing less volatility. Real estate has consistently outperformed the S&P 500, and annual returns on passive investments are generally in the high teens to low 20 percentile range compared to the 9% average return of the stock market. Multifamily housing also has a proven track record of weathering recessions better than just about any other investment. For example, in 2009, the Dow Jones was down 54% and loan delinquency rates reached 4% nationally for single-family homes. By contrast, delinquency rates on multifamily mortgages peaked at 0.4%. That's 90% less delinquency than single family. So this asset class basically shrugged off the Great Recession, which was caused by a housing crisis. That is resilience. That is why investors like myself and many others are moving funds out of the stock market and into multifamily real estate. Now, I spoke earlier about these investments having annual returns in the upper teens to low 20% range depending on the project. Well, 10 to 12% of those returns come in the form of quarterly cash distributions. This checks a huge box for busy professionals, especially oil and gas professionals, who are looking for an investment that could provide a separate income stream not dependent on commodity prices. I cannot emphasize the peace of mind that this offers enough, knowing that no matter what happens with my job or the oil industry, I know this cash flow will still provide for myself and my family for years to come. Another box it checks for busy professionals is the fact that the investment is truly passive and that it requires no additional investment of time or resources once the initial investment is made. This means there's no worry of becoming too distracted from your full-time job or having to spend years of learning the real estate business, which is guaranteed to include some tough and expensive lessons along the way. Instead, your investment is managed by professional real estate teams with decades of experience and proven track records of delivering results to investors. And last but not least, the generous tax benefits. Passive investors are actually limited partners, so they physically own a portion of each asset in which they invest. This comes with a few key benefits. First, the peace of mind of knowing you own a portion of a tangible asset, not some piece of paper or electronic signal indicating you own a stock, but a real building and the ground beneath it that provides shelter to the people and the families who call it home. Second, and probably more interesting from an investment standpoint, is the fact that this physical ownership means passive investors are entitled to all the tax advantages real estate has to offer. Now, I don't want to get into the weeds about tax strategy, but investors can expect a significant write-off starting in year one from accelerated depreciation and other incentives available to multifamily real estate. For example, one investment I made in 2019 had a year one tax write-off of 77% of my initial investment. This is an actual screenshot of my tax filing for that investment. Guys, I will likely never have to pay taxes on the income I generate from my passive investments. Now, I know everyone's tax situation is different, but for me, this is one of the most attractive incentives to invest in multifamily real estate. Now, you're probably thinking this sounds too good to be true. You're telling me I can make twice the returns of the stock market without taking any time away from my job, and it comes with tax benefits that very few investments can touch? What's the catch? Why isn't literally everyone doing this? Well, I want to be very clear with what I'm about to say. This investment is not for everyone. First of all, very few people are qualified to invest in offerings like these. The minimum investment is typically $50,000 to $75,000, but just having these funds available does not mean that someone is qualified to invest. Many operators require passive investors to be accredited, meaning they must have a net worth of over $1 million or earn over $200,000 per year individually or $300,000 per year as a married couple for 2 consecutive years. If investors don't qualify as accredited, some offerings have spots for sophisticated investors, which is someone who may not meet the requirements of accreditation, but they can demonstrate they have sufficient knowledge and understanding of the asset class, business plan, and risks associated with the investment. The number of slots for sophisticated investors is very limited on each project, which again makes passive investing tougher to access for many mainstream investors. Potential investors must also weigh the illiquidity of this investment. Most projects have an investment timeline of 5 to 7 years, sometimes longer, so as a general statement, investors should be prepared to not have access to their funds for the duration of the investment term. Of course, there are cash distributions during the term, as well as the potential for returning capital through strategic refinances during the term, but my point is, these funds should be considered long-term investments. Now, to counteract that illiquidity, the target returns are more generous than what you'll find in more liquid assets. For me, I'm okay not having immediate access to these funds because I consider them very long-term investments. If I don't plan on using these funds, I might as well put them in something that provides the best long-term returns, right? Another reason this investment isn't for everyone is risk tolerance. People can lose and have lost money, sometimes even their entire investment in multifamily real estate. Now wait, red flag. Not even 5 minutes ago I was talking about how stable these recession-proof multifamily assets were. Now I'm trying to tell you that people have lost their entire investments before? How does this make sense? I understand why this may sound like I'm contradicting myself, so let's talk about the major pitfalls of this investment and why people have lost their money in their past. Multifamily has been and will continue to be one of the most stable and trustworthy ways to generate wealth for investors. And I stand by that statement, and I'm a pretty risk-averse person when it comes to my investments. But it's not simply my opinion. Let's look at how professional investors compare relative risk across dissimilar asset classes, which is using the Sharpe ratio. As you can see on the chart, multifamily real estate is indicated by the red star, has a higher return and less risk relatively than the stock market. So how could people lose money if their investment carried so much less risk than the stock market? The answer is people. The vast majority of failed investments have stemmed from human error with the sponsor or the management team in charge, whether it's inexperience and poor underwriting that led to an improper business plan, or a more deliberate deception stemming from a poor moral compass. Most failures can directly be traced back to the human element of this investment. For that exact reason, it is critical that passive investors perform thorough due diligence when vetting potential management teams prior to making their investment. How many years of experience do they have? What is their track record? Does their business plan match your investing strategy? Do they have strong moral character? What is their target markets? What is their target asset class within those markets? The list can get extensive, but again, the answer to these questions will allow passive investors to mitigate the human element, which accounts for the vast majority of the risk associated with multifamily investing. Many investors get excited about the concept and the numbers behind passive multifamily investments, only to get cold feet because they lack the confidence when it comes to choosing a group they can trust with their investment. I totally get it. I wasn't about to hand such a sizable chunk of capital over to just anyone and blindly trust that it would work out. It took an extensive networking campaign and due diligence process for me to finally find a group of sponsors with the right business plan, experience, and track record that fit my needs. When you start your own search, you'll start to realize there's actually a large number of reputable multifamily syndication teams out there who all have adequate experience, acceptable track records, and decent returns to investors. But is that really what you want when investing for your future? Just adequate, acceptable, decent? Definitely not, or at least not for me. So how do you single out a truly exceptional team out of all these groups who are just adequate? What could set one management team apart from all the rest? Well, let's talk about the group I chose and what I believe sets them apart from the many other suitable investment teams. Mark Kenney is in charge of Think Multifamily, a highly successful multifamily investment group out of Dallas, Texas. He has 25 years experience in real estate, a degree in accounting, a track record of over 6,000 units under management. He's a two-time best-selling author, and he's a well-respected thought leader within the multifamily investing space. Last year alone, Think Multifamily raised over $50 million in private capital from passive investors like you and I to acquire multifamily assets in Texas, Georgia, Florida, Tennessee, Alabama, and several other markets across the southeastern U.S. Their experience, track record, and $50 million raised from passive investors, many of which are repeat investors, was plenty of evidence their formula worked, and they were more than capable of delivering the results I was looking for. But that's not what set Mark and Think Multifamily apart from the rest of the crowd for me. I mean, there's plenty of groups out there that can deliver similar results to passive investors. What really made my decision for me was their core values. They don't just look at these properties as investments. I mean, sure, they have a focus and a mission to deliver results to passive investors. After all, this is a business. But I was blown away by their focus on community. Included in every business plan on every acquisition is a special emphasis towards improving the community and the lives of their residents. They accomplish this by allocating capital to build new playgrounds, dog parks, improve security systems, better lighting, landscaping, and other thoughtful improvements to common areas. They've unlocked a secret that most other investment teams have yet to discover, and it's given Think Multifamily and their passive investors an edge over the rest of the competition. You see, when there's an influx of capital investments in common areas and a renewed sense of community, several remarkable things begin to happen. Residents tend to stay longer, which decreases expenses associated with cleaning, repainting, and general repairs necessary to make the unit ready for the next resident. People start encouraging their friends and family to move to the complex, which increases occupancy and revenues. The residents develop a sense of pride and a desire to protect their new and improved community, which leads to increased safety and decreased expenses associated with crime and vandalism. You should be noticing a theme by now. By focusing on improving the community, Mark Kenny and Think Multifamily are able to decrease their expenses while increasing their occupancy and revenues, which of course is directly tied to the business's bottom line and returns generated for investors. By investing with Think Multifamily, I was able to earn great returns while simultaneously having the pride of knowing that my investment went directly towards improving the community and the lives of the people who live there. People to whom this apartment complex is not just a building or a business, but a home where they experience everyday life, celebrate birthdays and holidays, a place where they can find comfort within the walls of their unit. Now, hopefully you're starting to see why I'm so passionate about this investment. It's because it's bigger than me, and it literally changed how I view the world. All too often, we succumb to the false belief that our success must come at the expense of others. Someone else must fail so I can succeed. There will be the haves and the have-nots. Well, I'm here to tell you that's all BS. I can't speak for other investment groups, but at least with myself and Think Multifamily, these investments allow passive investors to generate incredible wealth by helping others, not at the expense of others. And you can't put a price on that kind of return on investment. Now, to wrap up my story, after making several passive investments with Mark and the Think Multifamily group, I realized I was so passionate about multifamily real estate that I could no longer just be a passive investor. I wanted to bring value to the active side of the investment team and earn a spot on the general partnership. Now, if you haven't read my Essential Guide download where I break down the structure of how these deals work, this may be a little confusing, so I'll briefly explain. Like I said earlier, acquisitions at this level are a team sport, and we talk quite a bit about the passive part of the team, known as the limited partners. The rest of the team is comprised of the active investors, known as the general partners. The general partners perform all of the active tasks necessary to acquire an asset, including locating and underwriting the deal, performing due diligence, developing the business plan, raising the capital necessary to close, and managing the investment after close. In exchange for these services, the general partners receive equity in the asset and split the profits with the limited partners at a predetermined ratio. So, like I said, after making a few investments as a limited partner, I was able to become an active member on several general partnerships with Mark and Think Multifamily by demonstrating my proficiency in underwriting deals, raising capital, and handling communication with passive investors. Actively partnering with the general partnership team has infinitely expanded my understanding of real estate, especially the multifamily asset class. And every day I try to soak up just a little more knowledge from people who have been in this business for decades. So that brings us to today. Hopefully you enjoyed my story and maybe even got a little shot of inspiration for it. But I hope you recognize I'm not here telling this story to brag or boast about my real estate success. This isn't about me. And like I said at the very beginning of this presentation, this isn't really about real estate either. This is about solving the problem we all face as oil and gas professionals. How do we overcome the fear, frustration, and vulnerability we feel knowing our income, our careers, our entire industry can disappear for reasons completely out of our control? I can't answer this question for you. Ultimately, you have to decide what steps you will take to protect your family and how to properly invest your hard earned money in a way that enables you to be better prepared to handle downturns. For myself and many other oil and gas professionals, passive investments in multifamily real estate offers the best solution by providing exposure to institutional quality assets that are managed by experienced professional investors. Multifamily repeatedly outperforms the stock market and has proven to be particularly resilient through even the toughest recessions. It provides predictable income via cash flow that can be used to reinvest and grow wealth during the good times, or it can be used to pay bills and keep the lights on when the times get tough. It delivers generous tax benefits so you get to keep more of your profits from your investments. It is completely passive, so you don't have to worry about getting distracted from your full-time job. Best of all, multifamily housing isn't going anywhere. Food, water, shelter, the three basic necessities that every human needs to survive. People will always need a place to live, and your passive investment in multifamily housing would provide them a place that is safe, comfortable, and affordable to call home. On top of all of this, we're about to embark on what many experts are predicting to be one of the greatest moments in our lifetimes to purchase multifamily real estate. Through January and February, the year 2020 was on track to break records in multifamily transaction volumes and valuations. For some time prior, large sums of institutional and hedge fund capital was fleeing what they viewed as an overinflated stock market to seek shelter in the multifamily asset class. Valuations were soaring. Investors were making incredible returns. The outlook couldn't have looked more promising. Then, out of nowhere, this thing called coronavirus was like, hold my beer, watch this. Seemingly overnight, the momentum and the exuberance of 2020 was brought to a screeching halt as the virus became a pandemic and eventually led to the complete shutdown as the economy we know it. Transaction volume dried up. After all, how can you inspect a 150-unit apartment building and perform due diligence with zero human contact? Even if you could find a deal and somehow inspect it with robots, banks basically put a freeze on financing for multifamily properties due to all the uncertainty. Sure, multifamily housing had performed well during past recessions, but was this combination of human and economic disaster too powerful for even the multifamily asset class to handle? All eyes were on rent collections just to see how devastating this blow would be. Management companies and real estate investors were bracing for impact, expecting the worst but hoping for the best as experts predicted 25% to over 60% loss of rental income from the disaster. Then April numbers came in and the data was stunning. The month of April ended with a 91.7% rent collected nationally, down only 4.2% from April 2019 and only a few percentage points off from pre-COVID March 2020 numbers. This had to be a fluke. There was no way collections could be that high. So all eyes turned to May collections. This would be the month of reckoning. Well, May came and went, and rent collections were 93.3%, down only 1.5% from the year prior. June numbers came in at 94.2%, which is only half a percentage point down from the collections of June of 2019. Of course, some markets are faring better than others, but so far the multifamily housing industry is proving what it does best, which is survive downturns. As for the assets I'm particularly invested in, if I were placed in a coma in January of 2020 and woken up in June of 2020 and asked to review our financials, I would have a hard time noticing anything was even out of the ordinary during that time period. So now is where things begin to get interesting. As states open up, more properties are hitting the market for sale. Banks are easing back on restrictions on lending after seeing the reassuring rent collection performance for the last 3 months. Remember how I said in late 2019 and early 2020, large sums of money were trying to escape the stock market for safety in the multifamily space? Well, with hardly any transaction volume after February 2020, that money is still on the sidelines hoping to enter. On top of all that, billions in additional dollars from shell-shocked investors who just watched the multifamily real estate market literally shrug off one of the worst black swan events in economic history are now hungry for the shelter that this asset class provides. Right now, we're seeing a slight uptick in potential acquisitions hitting the market, But we're really expecting the floodgates of 4 months of pent-up volume to fully open and make for a very busy third and fourth quarters for this year. Even with this increased competition in the space, we're confident our track record and focus on community improvement will tip the scales in our favor and allow us to deliver incredible, possibly once-in-a-lifetime returns to our passive investors over the next few years. As I mentioned earlier, I'm an active investor with Mark and the Think Multifamily Group, which provides me with a front row look at what is happening behind the scenes. Right now, between the many repeat investors who invest with us on asset after asset, and many new investors sent to us through word of mouth referrals, we have little to no problem raising funds to acquire new properties. In fact, most of our deals run out of room pretty quickly because we're only raising a specified amount of money for each opportunity. And once it's full, it's full. Despite the fact that most of our deals oversubscribe quickly and we aren't actively searching for new investors, if passive investing is something you want to consider, there's no harm in scheduling a quick call with me using this link or by simply going to calendly.com/qualification call. On this call, we'll discuss your situation and goals to make sure you're a good fit to passively invest with us. If it seems like you would be a good fit, we can then make sure you meet the minimum qualifications to invest with us. If those two hurdles are met, you'll be invited to join our investor pool and have access to our active investment opportunities. At this point, there's still no commitment on your part. You'll see active opportunities, but we aren't going to bug you or personally reach out to you to ask if you want to invest in a particular deal or not. If we have a deal that catches your attention, you can jump on it. If not, you can pass and keep an eye out for the next investment. While I can't tell you exactly what our future opportunities will look like, you'll gain some idea of the general business plan, asset quality, and projected investor returns by watching a previously recorded webinar from one of our deals in the past. If that interests you, just shoot me an email and I'll send you a link to view the webinar. Now, I do want to emphasize the importance of getting on a phone call with me first. The way we raise private capital for placement in real estate is highly regulated by the SEC, and I legally cannot even show you an active opportunity until this step is taken. If you decide real estate could be the solution to your problems, but maybe passively investing in multifamily doesn't sound like the right fit for you, no problem. There are a ton of ways to get involved, and myself and the Rigs to Real Estate community are here to help you get started. We have members with experience with just about every facet of real estate, including single family, multifamily, commercial, Airbnb, short-term rentals, student housing, you name it. We're all here to help one another find success and avoid the common pitfalls new real estate investors can encounter.
So if you're feeling stuck or can't figure out where to start, schedule a call with me using the same link and let's talk about your situation and goals, and I guarantee we can come up with a plan to get you started down the right path, the path that best suits those goals. Say we chat and decide single family rentals are the way to go for you. I'm not going to just say good luck and send you on your way. Guys, I'm an open book. I will literally give you everything I use to get started in single family. Everything from my market analysis spreadsheet to my property evaluation and financial tools. Maybe the best fit for you is to skip the single family step, or you've done single family and want to graduate to multifamily, but you want to be on the active side, not the passive side. I'm all for it. I'll show you exactly what I had to do to make that leap. The point is, no matter where you are or what your goals are, I want to give you the confidence to get started. That's what it's all about. Gaining confidence through knowledge, overcoming that initial fear, and getting moving in the right direction. Thanks for joining me for this webinar, and I look forward to watching the members of Rigs to Real Estate experience massive growth, financially as well as personal growth. And remember, once you do find success through real estate, be sure to stay active and help others in the group who are just getting started. Few things are more rewarding than showing others the path to generating a lasting legacy of wealth. Also, I'm seeing a few questions already in the Q&A section. How about, in the interest of time, I'll take all those questions along with my answers and email them out to the entire group this week. Oh, and one last thing. I want to make sure that this webinar provides as much value as possible to the oil and gas community. GoToWebinar will be sending you a quick survey, and your feedback will go a long way to helping me achieve this goal and make improvements where I can. So thanks in advance for taking a quick second to fill that out, and I truly appreciate your feedback. Have a good evening, everyone.